an escalating US-China trade conflict that has lasted more than a year. As investment sentiments turn cautious, even nervous, where are the bright spots for investors? Is there still good value to be found? Hi there, I'm Stephen Chia, and I'll be asking the experts on market insights just how to navigate the uncertain investment market. At UOB's Privileged Conversation session, looking at the second half of 2019, strategies to seek quality and value in a dynamic market were key. Setting the tone was UOB's Head of Wealth Management Advisory and Strategy, Mr. Abel Lim, who was carrying a spade to stress an important point.
Tonight we're going to call a spade a spade. There will be no rose-tinted glasses to tell you that the world is an amazing space to invest in. Instead, we'll be telling you what the market looks like, some of the key challenges that we see going forward, and some of the risks that you, as an investor, should be familiar with. The IMF has actually brought down global growth from 3.5 to 3.3% this year. This, of course, is clearly because of the ongoing trade negotiations between China and the United States. The bulls and bears are out. They've been having a tug of war of sorts, with no sides winning outright. This naturally translates into volatility into the market. But we urge customers not to fear volatility. Volatility can actually work for you, particularly when markets are up. That's when you want to de-risk your portfolio in profitable trades and wait for a time to enter markets when the markets has corrected and pick up good quality equities and bonds. We are in a mature part of the economic cycle. A part of the cycle where global growth is slowing, which it has, and inflation should be rising, which it hasn't, which is quite unique, which brings us to a possibility that we might have come back to a fragile Goldilocks environment, where inflations are low, unemployment is low, and interest rates are low and likely to get even lower. But it's also an environment where growth exists.
It's now more than a year since the United States and China began sparring over imports and tariffs. With tit-for-tat trade tariffs and a few rounds of failed trade talks in between, the dispute currently affects $250 billion worth of Chinese goods and American goods worth $110 billion. As the confluence of factors weaken both businesses and financial market sentiments, the escalation of trade tensions is starting to bite.
So we think that the trade tensions have morphed now into a strategic rivalry between the US and China, which will last for many years, if not decades. And it will, of course, have its ebbs and flows. We're in a relatively better time period at the moment after the G20, but we shouldn't get too optimistic.
I think it's getting more unstable. Deglobalization, would you say?
Potentially deglobalization. So yes, we think that the benefits of globalization that we've seen over the last 20 or 30 years, perhaps most importantly with China entering WTO and so forth, and the benefits that have accrued are now more questionable moving forward. And if you look at the chart, these really are huge multi-decadal trends that we've all kind of had. I've been in markets for 20 years, so certainly for my career and longer, this has been something we've sort of taken for granted. And in our estimation at BlackRock, we now can't take this for granted any longer.
To Ben's point, I agree that there are certain issues within both countries that cannot or probably will not be resolved in the near term. Things like the technological transfer of and intellectual property rights, trade practices, for example. All these are issues that are really very difficult for individual countries to come to agreement to, because ultimately they are two competing economies.
Every 5-year cycle, there will be a financial so-called uncertainty, a backdrop that is difficult. Now, what is important is at least we try to understand the best of how markets and how the economy reacts to the underlying theme and difficulty. And then, again, don't be afraid of the US-China trade conflict. Be very sure what's happening, and then be very clear with your investment thesis, and then you can put forth and invest.
But that's tough, right? You say be very sure. I mean, that's the one thing we can't be at all sure of anything in this day and age.
Well, indeed, look, if you look at it, there's a few positives that come out of it. Now, what is positive in this is that the central banks are very, very fast-moving in this cycle. And if you remember the previous cycle, most central banks would wait for a recession to happen before they talk about cutting interest rates or easing monetary policy. You look at the black line, that's 10-year German bond yields, was positive 50, 60 basis points less than a year ago. Now we are minus 40 basis points. Bottom chart, the dark red line, that's 10-year Treasury yields, US Treasuries, from 3% down to 2%, trading at par at Singapore government 10-year yields. So the question to us is this steep drop in bond yields justified, or is it too aggressive? We believe with fair certainty the Fed will cut twice this year, September and December. Why twice? Because the Fed's long-term inflation target is 2%. So we're going from 2.5 to 2 to neutralize policy to help buffer against the trade uncertainties and to see how things work out in the next few months. But we are not in the camp where the Fed will cut 4 times or 3 times, which means markets may have priced in too excessive an amount of rate cuts from the Fed, and there may be opportunities in the fixed income market to try to pick out trades from this.
Right, but then the impact is felt across the board in many other areas as well. Ben, your take, downstream impact to different asset classes.
To try and gauge the impact on differently weighted portfolios, weighted between equities on the far left of the chart and fully bonds on the right-hand side of the chart, and the mixture obviously in the middle, to see what happens if trade tensions flare up. In all candor, this is hopefully a good guess, but this is a guesstimate of what can happen. My takeaway from this is that the importance of having multiple sources of income, it's always important, but particularly when we are incrementally less certain about the world, how the world is going to look, tweet by tweet, let alone 6 months by 6 months, is vital.
And Khun Hao, what about foreign exchange then? Should FX also be an asset class? And can we expect positive returns from there?
These are indicators of benchmark currency indices with respect to Asian currencies and the renminbi. Now you see that big drop in the middle. That's the first round of tariffs from the middle of last year. FX and currencies, whether it's renminbi or Asian currencies as a whole, has reacted to the real reality of higher tariffs, of trade slowdown. Now, which means there are currencies out there which pay very, very good yield, currencies that you can adopt a carry trade that has been aggressively sold off. So if we adopt the view that the negotiations will go on, but things won't go very, very wrong, the authorities at the end of the day will adopt a cool head to try to work out a solution, then perhaps this is an opportunity to pick up some high-yielding Asian or emerging market currencies to add yield to your portfolio. Anybody who's investing in China or Asia will be very worried about dollar China trading above 7.0. It's a big unknown right now. Our forecast is that renminbi will drop past 7 to 7.10 by early next year, first quarter. We should not be afraid of it. Now, what this means is there are opportunities. The next round, you have another round of Asian currency weakness that follows the renminbi lower. Then perhaps it is a time to reallocate and look at a portfolio to try to manage against your key currency risk, whether it's against the dollar or against the Singapore dollar, and so on and so forth.
When Market Insights returns, we turn the focus to the investment potential of Southeast Asia.
Our currency should weaken a little bit because the Singapore currency is too rich. This is good because
the price of Chinese commodities and labor are on the up. The cost of manufacturing in China is rising. With US tariffs and the blacklisting of Chinese companies kicking in, businesses are looking elsewhere. Among the favorites are Southeast Asian countries.
The trade conflict has started to force manufacturers, whether it's Chinese or South Korean or international manufacturers, to move south from Guangzhou and Shenzhen down to the region. Now, this is a long-term, multi-year so-called shift in investment capital down south. And this is what is happening. If you look at it, you will find that if you invest rightly in the right industries, pick the right country, you will be well positioned for this big shift in capital down the region.
What about the slowdown in China? Is that a concern for investors?
Not necessarily. I mean, the reality is that China is still very committed to its deleveraging campaign. I mean, President Xi Jinping, of course, has called deleveraging a matter of national security. So China is managing this interesting balance between continuing to generate enough growth to maintain social harmony on the one hand, and yet continue with the very important financial deleveraging on the other hand. The room that China has to do more fiscal stimulus, if necessary, is absolutely there. For our money, we continue to see China slowly, in a controlled manner, and that's not anything to be particularly concerned about. It's very normal for an economy when you're getting to the size, the raw numbers of China's GDP in 2019 and beyond.
We have actually identified Chinese equities as a long-term mega trend. We believe that the structural changes that we are observing today in China is actually net positive. Things like the inclusion of MSCI, I believe they're going to bump up the inclusion to some 28% over the next couple of years, which means that benchmark-hugging fund houses, or rather investors, is likely to increase their allocation to China. On top of that, you're also talking about the rise of the middle income, the people who are now coming to the fore, people who are spending, people with credit, and people are looking to invest. Those monies will eventually find its ways into the Chinese economy. So I think that the Chinese government is actually doing a very, very good job in trying to pace out or spread out this growth, because you don't want an economy to be growing at a double digit and burn out before the time is up.
What about here in Singapore?
Okay, now this chart that you see flashed out there can be very depressing, but I'll take it with a positive pinch of salt. The bottom half of the chart is Singapore. The blue bars is our export contraction for the electronics sector. We have a significant contraction in electronics export, and that's dragging down our Singaporean exports. I would say this is a short-term adjustment to the new reality, and the authorities are aware of this. Our view is that our currency should weaken a little bit from 136 now to about 140 by the end of the year, because the Singapore currency is too rich, given the weakness in the economy and the trade balance. And this is good because a weaker currency will help a little bit to balance off the economic risk. So the red line, dollar Sing, should bump up a little bit from 136 now to about 140. So if you need to go to the US for travels later the year, may not be a bad time to pick up some US dollar now.
Ben, is there a silver lining for investors?
This is China fiscal and credit impulse. And the punchline is, as that moves into the top right box, you're getting both incremental credit loosening and incremental fiscal loosening. So we think in China, you're already starting to see policy offset some of the trade headwinds. The ECB and others, we think, are extremely committed to using all possible tools to prolong this economic cycle. So to your question, Steve, we still think sovereign bonds have value as part of a diversified portfolio, even at these extremely low levels of yield.
Before we go away with the wrong impression, rate cuts isn't the silver bullet. One should not assume that with cuts being implemented, that the world is going to be hunky-dory after that, and that global growth is going to shoot up to the roof. During the dot-com bubbles and preceding the subprime, rate cuts didn't really work. In fact, it actually got matters worse. Fortunately, today we don't see froth, a lot of asset bubbles at this current juncture. So we are hopeful, and we are probably aligned with the markets that this is a net positive for risk assets and, for the matter, fixed income.
Because the Fed is expected to cut interest rates, global central banks are expected to ease monetary policy. That's positive for gold. The other thing is the big boys, the central banks themselves, China, Russia, India, name it, are allocating more into gold. For individual portfolios, it's important to allocate a portion into gold because it's a portfolio stabilizer. As a big if things do go wrong, volatility comes out, risk aversion, and central banks cut further, this will be one asset that will move further up.
Coming up, which sectors present good returns with lower risks?
When there's a period of weakness in the economy, you don't spend less on healthcare for your family.
As the whispers suggesting an impending recession grow louder, the challenge for investors looking for good returns is to find a balance. The experts discuss the sweet spots in the current economic climate and the sectors that should show resilience.
So, Carl, with a dovish message in June, the Fed has signaled potentially cutting rates in the near term. Do you think that will impact fixed income investors?
Fed dovishness is actually one of the two biggest drivers for fixed income markets right now. When most people think about the recent tightening we've seen from the central bank, they look at it in the entire history of the Federal Reserve. And in a long historical context, they'll look at it and say, this is about the easiest tightening we've ever seen. Really, though, if we focus on the last 20 years, that round of tightening is actually the second most we've seen in the last 20 years, and that's much more meaningful. More meaningful still is the inflection, what we've seen from tightening to easing. Before the end of last year, most economists and market participants were expecting 2 to 4 rate hikes this year in 2019. As we sit today, Fed funds futures markets are pricing in a cut in the meeting in the month with a 100% probability. That is a strong positive catalyst for fixed income markets.
Whilst market's expectation has been closer to 4 cuts, we think it's overly aggressive. We don't think that the market is likely to experience such a hefty cut at this current juncture, given the fact that the market economy isn't exactly that bad. So at this current juncture, 2 rate cuts this year, possibly 1 in 2020.
The market clearly is pricing in a number of rate cuts. I think the Fed will very likely respond to that because asset prices would dip meaningfully if no rate cuts were delivered. But it doesn't seem as though the economic fundamentals, again, from an equity investor's perspective, really warrant significant cuts from here. So I think there'll be 1 as a hat tip to market prices, but I guess I struggle to see more than 1.
China is the other big driver for fixed income markets today, and this is the biggest jump in total social financing in China that we've seen on record. This is something that's going to feed through the economy for months to come. So if we think about these two global economic superpowers together with either a foot on the gas or at least off of the brake, again, that is a strong positive catalyst for fixed income markets. It's unequivocally positive for risk asset classes. In the developed world, ex the US, we're seeing a deceleration in growth. We've seen the opposite in EM. We've seen an inflection. We've seen growth pick up. It's accelerating. You're positioning yourself for success if you start to tilt your portfolio generally more in the direction of EM from wherever it started, and Asia too, as a subset of EM. The second thing is you want to try to retain some level of flexibility. There's a lot of uncertainty in markets today, and the temptation is there to just hide in the corner in the bottom left when you think about your fixed income allocation. Just go to a money market fund or just cash. You want to try to find value in the upper right hand there, these full maturity government and credit funds, but you should take some of your capital and try to find something in the middle. Look for some sort of liquid, stable reserve solution that pays you a little bit more than you would staying in cash or money markets, but gives you flexibility. So when you see value emerge somewhere else, you can move into that asset class. You don't want to be seduced by a high headline yield. You don't want to, like I said, be lulled into a sense of complacency because of monetary policy easing. You want to be increasingly critical or selective, or find somebody that'll be selective for you.
Well, the seduction idea is always a bit tempting and deceptive, and healthcare and innovation are areas that seem to be a no-brainer. Against the backdrop of slowing growth, would healthcare still be a resilient sector?
When there's a period of weakness in the economy, you don't spend less on healthcare for your family. It's one of the things that you would cut your spending last to. And that certainty of the spending from consumers makes the sector inherently more defensive in nature. If you look at the population in the developed world, and populations in emerging markets are also aging increasingly rapidly. And as we age, our demand for healthcare increases, our spending on healthcare increases. So that's a long-term structural story. Across emerging markets globally, but more than anywhere else here in Asia, wealth levels are rising. Their ability and desire to spend more on healthcare really increases materially. Another long-term structural driver. And then the third one, and really here a focus within our portfolio, is on companies that are innovation leaders. Now, innovation within the healthcare sector is a really long horizon process. It takes years and years, typically more than 10 years, to bring a new treatment, a new drug to the marketplace. But in our view, it's the companies that are innovation leaders in things like new drug discovery, in developing treatments for diseases that don't yet have treatments available in the market, that they will be the winners longer term in terms of a revenue perspective. The healthcare sector globally historically has been dominated by the US, but the advances that we're starting to see coming in China are really very, very impressive. Now, a great deal of this is in pharma, biotech, and medical devices, medical technology. And that's a market that is rapidly rising. China used to be a global trading economy. It's now a domestically driven economy. Within that, company earnings, only 10% of company revenues come from overseas. The Chinese equity market is a domestic equity market. And within the Chinese domestic equity market, the healthcare sector is very close to 100% domestically driven. And so actually investing in China, investing in Chinese healthcare is a fantastic hedge against global trade uncertainty because the market isn't driven by global trade.
This is our second half view. You need to build resilience in your portfolio. Identify opportunities to go into good quality assets. We favor Asian investment-grade bonds. On a valuation standpoint, it's actually relatively cheap today. And on the fundamental standpoint, the interest cover, for example, is 8 to 9 times. China, healthcare, AI, relatively or still very much intact, although there will be noises along the way. And last but not least, we think that the US dollar is likely to strengthen against regional and Asian currencies, but trending slowly down towards the developed market ones.
Well, you've heard from the experts, and I hope their key insights will guide you in your investment journey in the months ahead. Goodbye.
Brought to you by UOB Privilege Banking.